So learning module 8, equity valuation, we will start with a very simple idea. Let's say that is a business. Right? So, okay, let's say one of you has a business, right? So this business, whatever the name is, this generates some profit, right? So this generates some profit, it has some assets. What are the things that you would look at when you want to buy a business is look at their assets, look at their earnings, right? And we want to value it, okay? So maybe one of your friends, you guys are probably like becoming portfolio managers and not interested in running the business, your family business. So your father's friend's daughter wants to buy it and run it, okay? So what will she do? How will she value it? Like, let's consider that. So in your level 1, there are 3 techniques that are being taught. So we will have 3 people use 3 techniques, right? Now this first one, let's start with the first one as a balance sheet or the asset approach, right? So what this girl is doing is she's coming and talking to your dad and asking, okay, what are the assets that you have in the business, right? What are the assets you have? So what do you have? You have as assets this is the person who is coming. Let's call her some name. All right. So A, let's call it this person A. She wants to look at the net worth, the assets of the firm. So the assets are your property, plant, and equipment, your fixed assets, right? So maybe this is some amount, 5 crores. You have some cash. What else are assets? Inventory, right? So inventory, I heard, stock or inventory. And then maybe you have some intangibles, maybe a little bit other assets. Okay, we'll call this as other. Okay, so maybe 2. Okay, so it adds up to 10 crores is your assets. Is this the value of the firm? What should I do now? Subtract the liabilities. Okay, now on the liability side, what do you have? Okay, if you have debt, yes, okay, you have some debt there, loans or borrowings you have. Okay, let's say this is 2 crores. Okay, what else you might have? You might have accounts payable. Yeah, so let's say that is another 1 crore. Okay, something like that. Other like income taxes payable, wages payable, other debt. Okay, so you have, let's say, 2 crores. Okay, so this adds up to 5 crores of liabilities and 5 crores of assets. So what is the valuation now? 5 crores. So the net assets, what A has come up with is 10 minus 5 is 5 crores. Now, so she goes, tells your dad, like, I'm going to be willing to buy it at 5. I did this detailed analysis. I took all of this assets and I subtracted the liabilities and I got this as your answer. Okay. Now, is this okay? Is there something that we have to do any adjustments or anything like that? Yeah, so the property, plant, and equipment might be what the difference might be. The owner might say, no, these are not the current values or the market value. This is in the balance sheet. It might be like at the time I purchased, but right now the market price has gone up. You need to do a fair valuation, right? So you might try to do that. So maybe that is like, he goes and says 5 crores. The owner is willing to sell for 10 crores, okay? And so he's willing to sell for 10 crores. And then your friend, she does some analysis and then says, okay, fair value adjustment, FVA, fair value adjustment. And then she adds another 2 crores to this. And then she comes up with 7 crores. This is your adjustment for the current price versus the book value. FVA is your fair value adjustment. Okay, so this 7 crore is called as the valuation that you have done. It's called as the fair value price. This is the fair value price. Right? So you have valued it. And this is called as what? The 10 crore. This is what the person is willing to sell. This is called as the market price. Right? So in the market, this is the price that's available. This is what the owner is willing to sell. And this is what you have come up with as valuation. Okay. Now, what should your friend do? Should she buy this company or not? The fair value adjustments. So the question here is like, what is this 2 crores? See, this is basically the increase or decrease from the book value. So in your business, you might have the assets of the property as 5 crores. but that is when you purchased it maybe in 2010, right? So then you call an appraiser now and you say, what is the current price? He or she will do an appraisal and say, okay, it is actually 7 crores right now in the market, which means you have to increase the assets by 2 crores. That is called as a fair value adjustment, right? Okay, so now the market price is 10 crores and your friend has come up with a valuation of 7. Should she buy the assets? Should we buy the company or not? She should not buy. She should not buy, right? Because this market price is greater than the fair valuation, right? This we call as overvalued. If the market price is greater than fair value, we call this kind of a company or a security as overvalued, and we say either do not buy or sell. The market price is 10. The 7 crores is our valuation. That's what we did. That's not the market price. In the market, your dad is willing to sell. He's the one in the market, right? He has put his business for sale for 10 crores. That is the offer price, right? But you have come up with a value. I mean, your friend has come up with a valuation saying it is 7 crores. But she's not willing to pay 10. And your dad is not willing to sell it lower. So there is no transaction here. Now, let's say your dad says, I'm still willing to sell. You're not, running this business. So you ask some of your other friends. Okay, then another friend comes in. Let's call his name as P. Okay, so let's say Mr. P, what he says is, before we go to P, let's do R. So let's say another friend, Raj, comes in. Raj is, okay, you have a lot of balance sheet assets. I'm not very good at it. Let me just ask around and see what is the recent transaction for a similar business. Okay, whatever this business is, let's say this is a retail shop, similar business, what was it sold for recently? Okay, so he goes around and finds same street, same kind of a business. That business was sold for, say, 8 crores. This business was sold for 8 crores last month, a very recent transaction. Okay, but what happens is in this 8 crore business, this business was making a profit of 1 crore. Okay, this business was making a profit of 1 crore and he had sold this business for 8 crores. This is a similar business. We call this as a comparable or a peer, and this one was sold for 8 crores. So what Raj is doing is he's going to look at this business that he's interested in, and he finds out this business makes a profit of 1.5 crores. Okay. So based on this information, what should Raj value this business? Okay, he's found a comparable business that made 1 crore profit, sold for 8 crores. This business he's interested in is making 1.5 crores. So what is the valuation he should come up with? See, right now in the market, recently, one business sold for 8 crores, and that business made a profit of 1 crore. The business you are interested in, the business you are targeting, is making a profit of 1.5 crores. So how much will you pay for this if both are same kind of business, everything is similar? 12 crores, right? So you will pay 12 crores for this business, because if 1 crore is giving you a valuation of 8, 1.5 will give you a valuation of 12 crore, just cross multiplication, right? So this is called as a multiple approach or relative valuation. We will talk about this. So you're just finding a comparable transaction or a company that got recently sold or transacted, and you are valuing this target company. Okay, so that's the approach that Raj took. And Raj came up with a valuation. Now, how much? He said he's willing to give 12 crore valuation, and the owner is willing to give for 10 crores, right? So what do we do now? Should we buy or sell? We can buy now, because in this case, it is undervalued. The company is undervalued based on Raj's valuation. Your 10 crore of market value is less than the 12 crore of fair valuation. So this is undervaluation. So we saw two methods. And last one, Parak, what Parak is saying is, I don't want all this assets, transaction. I am a believer in cash flow. I want cash. Cash is king. Tell me what is the cash that this business generates on an ongoing basis. Okay. So he asks this one, and then he does some math, etc., and he finds that this business generates on average 1.1 crore of cash. Okay. So this is the amount of cash. So the cash doesn't have to be equal to the profit. Okay, it's not the same. Cash will be different than the profit because of various reasons, right? So we will talk about those when we come to FSA. The cash flow and the earnings doesn't have to be the same. It could be different. So this is the free cash flow to the equity holders, and she's finding that the cash is 1.1 crores. Now, if I told you that the market rate, the rate of return in the market, discount rate or rate of return is 10% in the market, what's the valuation of this? If you have watched the calculator foundation and the math foundation, you know how to calculate this. This 1.1 crores we will assume is constant throughout the years in the future. Right? We call that as a perpetuity. That means forever, this cash flow. And it is not growing. Let's assume that this is like a old school business and we are not expecting any growth from this one. 1.1 crores forever cash flow that you're getting. The expected return is 10%. What is the value of this company? What's the formula for perpetuity? See, if I tell you I'll give you 10,000 every year forever and the interest rate is 10%, how much will you give me now? 11 crores. Very good, very good. So that's what. So what she said is basically for perpetuity, it is your cash flow by the discount rate R. Right? And this can be any kind of cash flow. It can be dividend, it can be free cash flow, whatever the cash flow is. Here, I'm using the free cash flow to equity, 1.1 by 10%, that is in decimals 0.1. So it comes to 11 crores. Very foundational equation. This perpetuity equation, everyone should know, right? If someone told you, I'll give you some money forever, what is the valuation? You just divide it by the discount rate. So this is the third method. Like, you might wonder, like, why is there all this difference? Is this, everyone did a rational, logical way of valuing this company, but they all came up with different numbers. So this happens, right? That's why you see equity analysts, research analysts come up with different target price. So first of all, they will do different methodology to value a company, but also in terms of the weightage they give. A lot of analysts will do more than one method, right? But they will assign more weightage to one of these techniques. None of these techniques are wrong, right? But they serve different purposes. Some of them are more suitable for certain types of industries, right? So we will talk about all of this in detail. Now, tell me one thing. What is the issue with the first method that Aviksha did? See, if you go to Infosys and then you look at the balance sheet, find all their assets, subtract the liabilities, is that going to be the market value of Infosys? Why? It's not going to be. But why? Because see, there are some things like goodwill and process and knowledge that cannot be put in the balance sheet, right? The valuation of Infosys, like, I mean, when Narayana Murthy used to be in the 90s, before he was talking about 70-hour work week, he used to say that my biggest asset used to walk away in the evening and come back in the morning, right? So the biggest asset is the people, the knowledge, the process. Like, how do you put that in the balance sheet, right? So those things you are not bringing in. The future growth rate you're not bringing in, right? So a lot of those are not brought in your first method, right? So this is not good for tech companies, but you can use this for holding companies, mining companies, those that have commodity, like, you know, things under the ground that you can just quantify and value it, right? The second one, relative valuation, right? That's a very popular one. Like, in fact, Warren Buffett uses that. He popularized the price to earnings back in 1970s, right? So relative valuation is something that everyone does. It's a quick back of the envelope math. It takes like 10 seconds to do a relative valuation, right? So what's the good thing about that? It's easy to compute, easy to compute. What is the issue with that? The other company is not, no, you're taking an average, let's say. You're taking all the peers and you take an average. What's still the issue? Not every business is directly comparable. Yeah, so there are differences. Like, what is the primary difference when we use relative valuation is the growth rate, right? If I look at Tata Steel and Jindal Steel, they are very similar business. They do similar, exactly same, but the growth rate of one company might be different than the other. So how do I adjust for that, right? I'm not doing that, right? I'm just looking at the current earnings or the next year consensus forecast, but I'm not adjusting for the future growth rate, things like that, right? So that's a but very popular, very useful metric. And the last one is the present value method. The P stands for present value. Right? We are bringing the future cash flows to today's value, right? So this is called as your present valuation or discounted cash flow method, the third one. We are going to see all of this in detail, but this one, the last method, is by far the most important for us from a CFA standpoint, okay? We will see all the three methods, but we will spend a lot more time, energy in this third method because we value securities primarily by discounting their future cash flows. That's the methodology we use in fundamental analysis often, right? Any security, fixed income. So when we value a bond, we are looking at the coupon, the future value of the bond payment, and bringing it to today's value. Same logic we are using here. Find the cash flow of the equity security, forecast it, and bring it to today's value. All right, so this is just a very simple overview. And now we are going to look at as per the learning outcome statements. We'll go and make sure we cover all the statements. So, but this learning module 8 is just going to go in and elaborate on these three methods. That's all we are going to be doing, okay? This is a very important topic, not only from an examination, like if you work, if you're doing equity research, you're going to be doing this a lot. Okay, now, learning outcome statement 1 says, evaluate whether a security given its current market price and a value estimate is overvalued, fairly valued, or undervalued. Okay, so this LOS1 is asking us to find whether a security is overvalued, fairly valued, or undervalued. We just now said this. We already have discussed this. What's the definition of overvalued? Very good. Market price is greater than your fair value. We call that as overvalue. If I say that my market price, so this is not always the norm, but typically they will say this in the question, but typically plus or minus 5% above or below the fair value, that's considered a fairly valued security. So if something is fair valuation is 100, 95 to 105, that range is considered a fair valuation. Okay? And when market price is less than fair value, we like it. We call that as an undervalued security and we want to buy it. Okay, now it's a little bit of a curveball. This is a question from your curriculum practice. So let me say a security that is highly tracked. Okay, let's say Apple ticker AAPL. Okay, is currently trading at say $230. Now you have come up with a valuation, and you are saying that the fair value is $160. What should you do? A, sell the shares. B, do more research. C, buy shares. Apple is currently trading at 230. Fair value is 160. Some of you are saying buy shares, I heard. No. You should not buy. This is called, isn't that contrarian view? Like we buy when pivot is low. No, we should like sell based on what we talked about. We should sell the Apple shares. But what we will see later on, like in one of the topics previously that we haven't seen, market efficiency, the information of securities that are well known is almost always reflected in the share price. Whatever is known, that information is already reflected in the share price. See, because Apple is covered by who? All the big investment banks, and they are all extremely smart people. And then we come up with a valuation that is significantly lower than the market price. We should first go and look at the assumptions. Did we make the right assumptions or not? Before we, okay, it's okay to be different than the market, But before we go ahead and sell, we need to understand what is the implicit assumptions inbuilt in the market. What is the implied growth rate? What is the cash flow forecast, right? So the correct answer actually is do more research. But if you thought it is sell, that's fine. I understand why you're saying it is sell, because that's how we have approached it so far, very simplistic manner. But the right answer would be for a security that is extremely widely tracked, that you need to first go back and validate your assumptions before you go ahead and sell or buy the security. Okay. So now we are going to look at 3 types of valuation in your level 1. So these 3 types are probably 95% of the valuation in the equity side. So the categories of equity valuation model. So what did Parak use? That is called as the last guy, present valuation, right? So that is the most important one. We call that as present value model. So what we are doing here is bringing the future cash flows to present value. That process is also called as discounting, the process of bringing the future cash flows to today. So we often call this as discounted cash flow as well. And this gives you the intrinsic value based on foundational fundamental concepts. So it is also sometimes called as intrinsic valuation. All of this mean the same thing. And depending on the cash flow that we use, you have various subcategories in this model. So if I use dividend as a cash flow, we will get dividend discount model, which is the first model. In fact, the most of what we will cover in your level 1 is your dividend discount model, DDM. So dividend is a cash flow given by some companies. Not all companies pay dividend, right? If a company pays dividend, you can directly use that for discounting the cash flow and get the valuation. What other cash flow we can use? We can use the cash available to equity holders. That is called as free cash flow to equity. We will talk about how to derive this, how to get to free cash flow to equity. And free cash flow to firm. What's the difference between the second and the third? Free cash flow to equity versus free cash flow to firm. Like, what is the difference between the cash flow to equity holders and cash flow to firm? What is the difference? See, the one major difference is what? Yeah, interest expense. So it is before you pay the interest and any debt service, right? So that is cash flow to firm means all, not only equity holders. Who is the other people apart from debt holders? So for everyone, which means you have to include the interest also. We will not subtract it. We will include that. Then obviously there's a tax benefit with interest. We like interest because it gives you a lower tax, right? So you need to adjust for the tax shield and then calculate the free cash flow. So we will calculate both. And I mean, I think in your level 1, the focus is primarily on your DDM, but we will just look at it in brief, how to do FCFE and FCFF valuation as well. Okay. All right. So this is the last guy, Parak, when he did this. The second guy, what did he do? What is that model called as? Relative valuation. Very nice. So this is relative to another company, right? We can also call this as a multiplier model because we are using multiples there. If I pay 8 times for $1 for that firm, and this company is making 1.5 crores, then it is 8 into 1.5. So we multiply it, right? So we call this as a multiplier model. Basically, that's what we are doing. We are multiplying. And here there are many kinds of multiples we will use. Price to earnings is the most popular one. PE ratio. But there are other ratios. Price to book. Book value is the equity in the balance sheet or net worth. You can use price to sales, price to cash flow. A lot of metrics can be used. One overarching metric that covers both equity and debt is your EV, enterprise value by EBITDA. I think these are the metrics we see in your L1. EV stands for enterprise value, not just the equity value, but the overall firm value. And EBITDA is one of the income statement margin metrics, earnings before interest, taxes, depreciation, and amortization. Okay, this was the second person. I think this was Raj. The first person, what did he do? She did, Aviksha, A, right? So A stands for asset-based valuation, right? Net asset valuation or asset-based valuation. So this is the simplest one. This usually acts as a floor. This is usually not what we would go with, but this is the minimum price. Like you need to at least buy it for the book value, what's in the balance sheet. So our focus is going to be on dividend discount model. Okay, dividend discount model. Just an overview. Okay? So don't worry about the details. We'll get into the nitty-gritty, so you'll spend some time on that. Okay, now let's go into dividend discount model. But the first question I want to ask you is why dividends? Why can we use dividends? Is dividends all the cash flow? Why are we using it? Why should we use dividends? Because if a company is generating 100 crores, will they give 100 crores of cash as dividends? No, they only give a part of it, right? If I have net income is what? The final bottom line in your income statement after subtracting all expenses, taxes, everything. That's your net income. You pay interest after net income or before net income? Before net income. Do you pay dividends before net income or after net income? After net income. So equity guys get paid after everything is subtracted, after we pay taxes, right? So equity dividends don't have the tax advantage that interest has. So anyway, so net income is there, but you can think of net income as a proxy for CFO, cash flow from operations, let's say, just very, very bad proxy. It's not an exact proxy. But what do we do with net income? We can do two things. One is dividends, right? You can give dividends from net income. That's what we said. Or you can also buy back shares, but both we will assume as same. This is called as a payout to the shareholders. From your profit, you're giving back to your shareholders, right? That's why shareholders are investing, for getting some money back from the investment. What's the other thing you can do? I heard you once say it. We can retain it. We can retain it for various purposes. It can be for investment. It can be to strengthen your balance sheet, keep it as cash, right? For acquisition in the future, whatever, right? So we are going to be buying from property, plant, equipment. You are retaining for the future growth of the firm, right? You're going to help the company grow. If you don't retain anything, if you don't put any money back in the business is not going to grow. In fact, it might come down because you have depreciation of your assets. Your assets are going to come down and you will eventually lose revenue and profits. Okay, so, but my question is this, very simple question, right? Why are we only caring about this? Why are we ignoring this part that we retain? If I just use dividends, I'm ignoring the part that I am retaining, correct? So why are we doing that? Am I making some mistake? Why are we only caring about the dividends? But what about the cash? You also have ownership, right? What about the cash that you're investing, you're retaining, the property, plant, equipment? How do you value that then? All right. So the reason why we care about dividends is because eventually all the cash flow to the equity holders is in the form of dividends. I think that's what you're saying, right? Eventually we will get cash. If the company is going to go bankrupt also, before that they will do a liquidating dividend, right? And any retention, the purpose of this is for growth, right? Which will boost the dividends in the future. Your dividends is going to go up in the future, so you will get a higher valuation. So this one we are not ignoring. This is going to be factored in the terms of higher dividends in the future. We will look at the relationship between this retention ratio and the growth rate later on, right? So there is definitely something to be talked about, the retention. If we don't retain it, actually the dividends will start to come down, right? So this is helping the dividends as well. Okay, so that's your first LOS here in dividend discount model. They're asking, why is dividend the right metric to use? Okay, so just a couple of simple formulas that you might already know from your accounting, or if you have attended FSA here. So the two ratios that I want to talk about is payout ratios. This is your dividends by net income. This, I'm simplifying it. Any share buybacks also we are considering as a dividend. For our L1, we will just keep it as dividends. And the other ratio is your retention ratio. I'm going to notate this as P. And the retention ratio is net income minus dividends divided by net income. You can also say the numerator as retained earnings. What you don't pay out is what you retain. How much of the earnings do you retain is called as retained earnings divided by net income. And this is usually notated with B, okay? You can also write this as 1 minus P. This you can obviously write as 1 minus P. If a company has 140 million in net income and their dividend per share is $2, per share, and total outstanding shares is O/S is outstanding shares is 40 million. What is their retention ratio? Just an application of the formula that is right above. Calculate the dividends. I told you the dividend per share. I also gave you the number of shares. You can calculate the dividends. Subtract that from net income and divide it by net income. What is their retention ratio? So your dividends is 80 million. So that means you're retaining 60. So 60 by 140. So my retention ratio B is equal to retained earnings by net income, which is 60 by 140, which is probably something like 0.428. So your retained earnings is 60 because the dividend is 140 minus your dividend of 80, right? So 40 million multiplied by 2. So total dividend is 80. So my retained earnings is 60. So 60 by 140, my retention ratio is 42%. So for every dollar, 42 cents, we retain 57 cents, 57.2 cents we distribute. Yeah. Okay. So now then the next learning objective statement, outcome statement is asking us to understand a little bit about dividends. It's pretty basic here. So we'll just spend maybe like 10, 15 minutes on understanding dividends. So there are types of dividends. Okay. So when we talk about dividends, at a very high level, we can divide this into cash and stock dividends. Cash dividend is the more common one. That means you get cash for each share you own. So if you have a share and they will give you a certain percentage of the face value usually, right? So if the face value of a share is say $2.5, they might announce a 150% dividend. That means it is 2.5 into 1.5, which is, so that is the dividend. That is based, it's a cash dividend based on the face value. The face value is not the market price, by the way. So the market price might be something else. Maybe the share is trading at 150, but this is the common stock, and there is a APIC, that's an additional paid in capital for the market valuation. Right? Anyway, for our understanding, this cash, right, is the most common one. This is a cash that is paid for every stockholder. Now, this can be a regular dividend or a special dividend. Regular dividend is something that you expect to be paid on a periodic basis. It is part of their dividend policy, right? So if I have some cash flow, we said this company is paying how much? 57% roughly. If I have $100, they are going to give out $57. That is their payout ratio. If the retention ratio is 42.8, the payout ratio is 1 minus that. 1 minus 42.8, 57.2, right? That is you expect. That is what you expect. That's your regular dividend. And this is going to be consistent. Special dividend, on the other hand, the name itself is special. It is not something you should expect. Maybe there is a one-off gain that you got, right? Something like a one of your instruments that you hold, your investments or your property, plant, equipment, when you sold, you made an extraordinary income or profit, unexpected gain, loss. In those scenarios, you might give a one-time dividend, right, to clear off that excess cash you got. Okay. It could be also maybe because someone acquired your firm and they gave a special dividend, something like that, but it's not something you should expect going forward. So it is a special. The key word is this is irregular and it is not to be expected, right? Let me ask you. So when I'm trying to discount the cash flow, should I consider both the dividends and bring it to today's value? Both the dividends? No. We should only consider the regular dividends. Special dividends we should not consider. We can't estimate it. We should not use that in our forecasted dividends. So the point here is this you should not consider for valuation. We should only consider your regular dividends. Okay, now there is a bit about stock dividends. I don't know why they gave it here because we don't use stock dividends for any part of valuation, but we will talk about it because it's in your LOS. A stock dividend is like this. So if a company has certain number of shares, they might say, instead of cash, I will give you a percentage additional shares of the total outstanding shares. An example would be, if they say it's a 10% stock dividend, if it's a 10% stock dividend, for every 10 stock, you get one additional stock. One share for every 10 shares. That is a 10% stock dividend. If it is a 20% stock dividend, you will get one for every 5 shares. So that is additional stock. You're not getting cash, only extra stock. If a company announces a 20% stock dividend, the company has total outstanding shares of 10 million and current share price, current market price or share price, let's say is $40. What is the old valuation? First of all, we will do a two-part question. What is the old valuation? All you have to do is market price multiplied by outstanding shares. Now, after this stock dividend, what happens to the valuation? What happens to the new valuation? So now the shares are now gone up by 20%. So instead of you're having 10 million, you're going to have 12 million outstanding shares. Okay. But what happens to this valuation? Total valuation. What is the total valuation going to be? Is it going to go up by 20%? Is it going to go up by 20%? No, the valuation is still the same. Just because I announce some stock dividend doesn't mean the valuation changes. Okay. Okay. Just because we announce extra shares, the value of the company, will it increase? No, like we didn't do anything, right? We just like gave more shares. Okay. So the valuation is still the same, but your outstanding shares went up by 20%, right? That's what happened, right? Which means what is going to happen to the share price? That's going to come down by 20%. So whenever there is a stock dividend, the value of the firm doesn't change. Your shares are going to probably increase, which is offset by an equivalent drop in the share price in the market, if everything else is being kept constant. Okay, if there's no other change in the valuation, the only change was the new dividends, stock dividends. So let's do this. 400 million by 12 million. So the new price is 33.33 per share. Now, what we saw is dividend. Something related to this is stock splits. Okay? And you might have heard about the stock split where you will be given more shares for your existing holding. It's not necessarily a dividend. So it is usually in the form of M for N shares. So usually this could be like a 2 for 1, 5 for 1, 3 for 1, 10 for 1. So it is, you're getting 2 new shares for one old share. So you read this as 2 for 1, 2 new shares for 1 share. That's a stock split. So if everything else is being equal, if there's a 2 for 1 stock split, what's going to happen to the share price? The share price will come down by half, like it will become a half of your prior price because the value is same. The value of the company doesn't change. The share price is going to drop right after stock split. So why do people do stock split if the value is the same? What's the purpose? What's liquidity, right? So see, if you look at Berkshire, which is at hundreds of thousands of dollars, not many people can buy it, right? How many people have like $500,000 sitting, right? Like you can't buy a share, but if they had divided it into some of the other classes, as you can see, is more affordable, right? You might be able to buy a share that is selling for 5,000. You can't buy a share like MRF, which is like at a very high price for any individual retail investor. It might be difficult to buy even one share, right? So the liquidity is going to improve, which will lead to better price. So in terms of like finding the market price, you will be able to get a better price. It's not that it is going to increase the valuation, but more participants are coming in. When more participants are coming in, you might get a better price revelation, right, for the people. So that's good. On the other hand, there's an opposite of stock split called as the reverse stock split. So the name itself tells you it is the opposite, right? So we are going to do something like 10 shares, you might get 1 share. 1 for 10. 1 new share. It can be any ratio. I'm just giving an example. 1 new share for 10 old shares. So if the current share price is, say, $8, after the reverse stock split of 1 for 10, what is the new share price? What would be the new share price? So 1 share you're getting for 10 existing shares. You'll give 10 shares and you'll get 1 share. Okay. So is that good? It's the same. It's the value to you doesn't change, but you have lesser shares, but the price of the share is going to compensate. So this $8 would have become $80, right? Because now you have only 1 share, but it is worth 80 instead of 10 shares at $8. Why do you do this? So back in 2008, I think it was March or February when Citibank did this, right? Citibank was having a share price of $3 at that time. Just like a few months, not few months, maybe like a year back, it was trading like $100. And then it has fallen to $3. This was in the peak of your global financial crisis, and people were talking about Citibank going bankrupt, just like Lehman and Baston's. And at that time, then Federal Reserve stepped in. But at the time, to inspire confidence, they did a 10 reverse stock split. For 10 shares, they gave 1 share. So this immediately went up to 30. So now what happens is a lot of the mutual funds can start to buy the shares again, because a lot of the mutual funds cannot buy penny shares, cannot buy shares that trade below $5. But now this stock becomes eligible to buy. And also it inspires confidence. If you see Citi trading at $3, it doesn't look that good, right? So now you have more confidence in the stock. So you see those kind of instances where you do reverse stock splits. Okay. As I said, this doesn't have a lot of direct application to valuation, but it is there in your curriculum. So I just wanted to cover these concepts. One concept that you have to know, though, is about the timing, the chronology of dividends. So that part is actually useful. There are a few dates we need to know. So the company will announce, they will declare the dividend. So that is called as the dividend declaration date. Let's say that is today. So that is today's date. Okay. Now, and they are saying they will pay a dividend on April 15th. Okay. So this April 15th, this is called as the payment date, dividend payout date, or dividend payment date. On the date of declaration, if you don't own the shares, will you be eligible for dividend? If you don't own the shares, today is announced, you might still be eligible if you buy it before one date. They will announce, they will call as the record date, right? Or holder of record or record date. Very good. So that holder of record. So let's say they announce this as 31st March. Okay, so the end of the quarter. Now this dividend amount, let's say, is $5. And this share is trading at now $50. Okay. So it is now at 50 and the dividend amount is 5. Okay, so it's now trading at 50. So you would think on the holder of record, it will come down by $5 because the dividend is paid out, the value is lost, $5. But tell me something. Is holder of record the right date for the dividend to be removed? This is called as the ex-dividend date, when the dividend is removed from the value of the share and the share starts to trade lesser than the dividend value from the current market price. Is holder of record the right date? No, because if I purchase on the holder of record, I won't get access to it today itself, right? In most countries, the settlement is T+2 or T+1, right? So you have to buy it 2 days before or 1 day before for it to be reflected in your name, for it to be in your account. Yes. So that is called as the ex-dividend date. So this might be T+2, which means 2 days before, right? It could be depending on the geography. Some geographies has 1 day settlement also. So we are talking about globally, depends on where you live and where you transact. Your ex-dividend date is when your dividend is going to be reflected. So this will come down by 5 and then it starts to trade up, hopefully like goes up. Right, so this is your ex-dividend date, usually like a couple of days before. Is it unfair to the old shareholders because like someone gets in now and gets dividend? Is it unfair? No, it's not unfair. See, the old shareholders would have paid probably lesser price, right? If the company is growing, it's a value, it's a fair valuation, right? So if an old shareholder bought it like in 2020, maybe he or she purchased it at $20, not $50, right? So they get to have that benefit, right? But the current valuation is 50 and the person is paying the fair value and then only getting it, right? And then they take $5 as dividend and the share price comes down by that amount. So it will become 45. So now let's start with the simplest one, DDM, dividend discount model. The simplest one is assuming no growth forever, no growth. If I told you that a dividend is $4 and discount rate is 12%, calculate the value of this company, assuming no growth, value of the share price value. For no growth scenario, you just have to use the valuation today is your dividend, constant dividend is no growth, divided by your discount rate. Just like what we did, just like what that Parekh person did. We are just going to take the dividend value, $4, and divide it by the discount rate. So 4 by 0.12, and that comes to $33. Just a conceptual understanding. If there is no growth, you're never going to value any company like this. Just to start with, just to get an idea. Now, let's say we have a dividend that is growing though. Let's say the growth rate is given to you, dividend growth rate, given as lowercase g. So if my current dividend at t is equal to 0, we will notate it as d0. My d1 is given as, d1 will be my dividend multiplied by 1 plus growth rate. Yeah, so that's how you will calculate the dividend for next year. And so on and so forth. If I want to calculate for D4, it's going to be D0 into 1 plus G. Right? So you will compute this like that, right? So you can calculate any period dividend if you have a constant growth rate. Okay, now we will start with 1 period DDM, very simple. Okay, so my dividend, we said, is $4 previously. So that is the dividend today at T is equal to 0. Now, what is the dividend year from now T is equal to 1. If my growth rate is 10%, it is going to be 4.4. So how did you guys calculate it? 4 into 1 plus 0.1, 10%, right? So 4 into 1.1, which is 4.4. Now, obviously, the company is not going to stop after 1 year. The dividend is going to continue. But just for our understanding, how do I value this company today? Valuation today is this dividend, let's assume, is already paid. We are only going to bring the dividend from the future to today's price, right? So we are going to discount this D1 to today. This D1, I need to discount to PV, present value of this dividend. So what's the formula for discounting a future cash flow? V0 is equal to D1 divided by 1 plus R to the power T, and this is 1 year, so it is just going to be 1 plus R to the power 1. You will never actually use the formula because we love TVM, time value of money. We will use the calculator function, but you need to conceptually understand what we are doing. We are bringing the dividend to today's value. But there's going to be dividend forever, right? So to simplify, because we are just starting with equity valuation, we will give you the share price after 1 year. Okay, we'll call this as V1 or P1. And let's say I'm giving you the share price as $40. If I tell you the share price is $40, then you will also discount that share price to today's value. Because I'm telling you the share price. In reality, no one will tell you. But because we are just learning, I'm going to tell you the share price in 2026 March. And I'm also telling you the dividends growth rate. Then you can calculate the valuation today. So if I have to do this, it's going to be 4.4 by 1.12. Our discount rate, we said, is 12%. Plus 40 by 1.212. And the price of the share is 39.64. This is your 1 period DDM, right? Very simple, right? Now you can extend this approach for 2 periods, 3 periods, like that. So I'm going to give you a 2-period DDM computation, just like what we did, but I would recommend that you use your TVM because it's 2-period. It starts to become a little bit more complex. But did you understand the concept of present value of the dividends? How you understand this one? Then we can do this for any number of periods. Let's say the dividend is $5. So this is your current dividend. Dividend is expected to grow at 6%. The price of the stock in 2027 March, say, is 68. If discount rate is 13%, compute current share price. Please calculate this. I'll just draw a timeline just to visualize. Discount rate is 13%, growth rate is 6%. Calculate the share price. I would recommend the TVM, but if you like the formulas, please, that's fine too. Okay, so this is a very basic question, obviously, but some of you who have never done TVM might find it a bit new. So that's the only part. You just need to get used to your time value of money. Then it's a very simple question. Okay, so I am going to use the TVM approach because it's always better, in my opinion. It's going to be accurate. All right, so my N is, for the first dividend, N is 1, right? My I by Y, we said, is 13%. Payment is 0. Future value is, how much is 5 into 1.06? So that is my future value. Compute my PV, 4.6902. Store it in one memory slot. So this $5 something, this one is equal to, in today's term, 4.69. Then the other one I'm going to add these two together. Let's do that. So my dividend, 5 into 1.06. This is my dividend, right? Store in 9. But I'm going to add the stock price also because both are at the second year. So I'm just going to combine it. So it becomes 73.618. Yeah. So this is going to be my future value and my N is going to be 2. Compute my PV. And this is equal to these two together in the present valuation is equal to 57.65. So we will have to add these two. So store it in another memory slot. Recall 1, first dividend in present value, then recall 2, which is your second dividend and the share price combined, and that comes to 62.34. Now, I gave you this value, 68, right? In your actual work, is someone going to come and tell you it's going to be 68 after 2 years? No, we have to figure that out. So there are various techniques you can use. The simplest one is, and probably the most elegant one, is given by Gordon growth model. This is a super important equation. What Gordon is saying is, we don't have to worry about the derivation. He has written a thesis, but we don't have to go there. What we are going to say is, my value today is given as the cash flow next year. For our purposes, we will use the cash flow as dividend. So dividend next year divided by R minus the growth rate, okay? Where R is your discount rate or the cost of capital, and G is your constant. This word is important. This is a constant. This growth rate cannot change. Constant growth rate. So my value at time T, be very careful here, is given by next year dividend. So if you are given this year dividend, you have to convert to next year dividend, right? That means if I'm given D subscript T, then I will have to multiply it with the constant growth rate, the long-term growth rate, divided by R minus G. This is at time T. If it is V0, then this will become next year, first year dividend divided by R minus G. If it is third year value, then I will use fourth year dividend divided by R minus G as an example. So let me ask you a very simple question. Again, this is more a conceptual check. This is not a kind of question you might get in your exam. If I say Walmart, ticker symbol WMT, has a constant dividend growth rate of 5%, long-term constant growth rate of 5%, and the current dividend is $5. Sorry, current dividend is $1.8. The discount rate or cost of equity is 11%. Compute Walmart's share price. So how do we do this? Very simple. This is basically your dividend in next year divided by R minus G. R is given as 11%, G is 5%. Please substitute in that equation. So your price today, P0 or V0, is given as your next year dividend divided by R minus G. So your current dividend they gave as 1.8. 1.8 multiplied by 1 plus G, growth rate is 5%. So 1.05 divided by R minus G. So R is 0.11 and your growth rate is 5%. So you're going to do this math, 1.8 multiplied by 1.05. So that's 1.89 divided by 0.06. So you get that answer as 31.5 per share. Okay. Okay, what's the biggest competitor to Walmart? I mean, in the brick and mortar space. Target, right? Very good. I mean, obviously the biggest competitor is probably Amazon, if you include e-commerce, but in the brick and mortar, it's going to be Target. So let's go look at Target. Target ticker symbol TGT. Let's say the dividend there is $2.2. And the growth rate in the short term, I'm writing it as subscript, yes, short-term growth rate. We'll just expand it also. My short-term growth rate is 10%, and my sustainable long-term growth rate, that is my constant long-term growth rate, is 4%. So this short-term growth rate, we will assume for the next 2 years. Cost of equity, my cost of equity is 12%. Compute target share price. So just help you with the visualization. So we have 2 dividends initially. We have a dividend today, which is 2.2. Then this is going to grow with 2.2 into 1 plus short-term growth rate and 2.2 into 1 plus GS whole squared. This is in your year 2. And in your third year, you will get this as 2.2 into 1 plus GS multiplied by 1 plus GS squared multiplied by 1 plus long-term growth rate, which is 4%, right? So this is 2 times you will multiply it with the short-term growth rate 10%. Then the third year, you will multiply that calculated the D2 with 1 plus 4% growth rate, right? And you will use that to calculate the value here, V2, using GGM, Gordon Growth Model, and discount all of this to today using the discount rate of 12%. So let's start with the dividend computation. You can just maybe calculate your D1, D2, and D3. Discount D1, D2, and using D3, you calculate V2 using GGM. All right, so let's do, I don't like to write it on the paper. In your exam also, it saves you time and will be more accurate. So let's just use the store and recall function in your calculator. That's the best approach in your exam as well. So let's try to get used to that. So my first dividend is 2.2. This is my current dividend. This is your D0, right? This is your D0. So now this I have to multiply with 1.06. Right? What's my short 10? 1.1. So this is my D1. I'm going to store this in one memory slot. I'm going to store it in 7. And then I'm going to multiply this with 1.1. This is my D2. Store it in another memory slot. Then I'm going to multiply this with 1.04. This is my D3. Okay. So my third dividend is $2.768. So just recall 7. This is your D1. Recall this is your second dividend. And this is your third dividend. You have your dividends. So now it is just a matter of plugging in your TVM. I need to know the valuation in D2 though. So for that, I'm going to use our super friendly Gordon growth model equation. So my 2.768 is my D3. So to get to my V2, I'm going to use my third dividend divided by R minus G. And we know the R is 12% and growth rate is 4%. So this is going to become 0.08 as the denominator. So this 2.768 divided by R minus G. So this is the share price in your second year, 34.6. Store this in one more memory slot. Okay. So now let's start with the first year dividend. First year dividend is 2.42. So I want to make that my future value. And my discount rate is 12. N is 1. Compute PV. So this is my present value of the dividend, 2.16. Store it in one memory slot. The second year, I have 2 things. I have my dividend, but I also have the price of the share, the second year share price that we calculated, which is 34.6. We have to add them both, right? And you get that as 37.268. That is going to be your FV. Change your N to 2 and compute your PV, 29.70. Store it in your second memory slot. Recall 1 plus recall 2. And you get the answer as 31.87. This is your valuation today, my 2.16 plus the value that we got here, 29.7 is 31.8. So what we did, we discounted this dividend, D1. I'll just, for the benefit, I'll just write this down. So this value came up to 2.42. The next value came to 2.662. The last one was 2.768. Now what we did was, we used this 2.768 to calculate the share price at year 2. So 2.768 divided by 0.08, and that was 34.606. So this is my share price here, 34.6. That if I want to sell this share, I will get 34.6 based on Gordon growth model. Plus, I'm getting a dividend of 2.6 at the end of year 2. So I'm adding these two cash flow, and then that I got that value as 37.268. This is the entire cash flow in year 2. So we use that as my future value in year 2, my N as 2, discount rate as 12, and compute my PV, and I get this value in today's term as 29.7. And the first dividend we discounted 2.42, and we got that value as 2.16. So together you add those two present values, the share price today is $31.8, $87 to be accurate. So we will have to do these kind of computations in the exam. This is a fair question. This kind of a level of difficulty you will get in the exam, okay? So this is what you would expect to get, this kind of questions. 2.16 is your 2.42 discounted to today. So 2.42 divided by 1.12. You use TVM, and then you will get that answer as 2.16. So the final answer, this 34.6 becomes plus your second year dividend of 2.682, and then you discount this to today, it becomes 29.7, plus your D1 discounted to today was 2.16. So together, we got that answer as 31.87. Okay, so far, I have given the cost of equity, but in the exam, they might ask you to calculate the cost of equity. And most often, we are just going to use capital asset pricing model. I'm not going to go into derivation for capital asset pricing model. This is something we will see in many other areas, how to think about CAPM. But I just going to give you this equation. So my cost of equity, or your discount rate for dividends, for dividend or FCFE, you can use capital asset pricing model, which tells you it is your risk-free rate plus the market risk of that security, denoted by beta, multiplied by RM minus RF. RF is your risk-free rate, notional rate. R subscript M is your market return, is the beta of the stock, which is the market risk. So for people who don't know what beta is, you can think of that as the volatility of the stock compared to the market. If I say the market has a beta of 1, let's say the market risk for market is 1, another security has 1.5, what it means is this security will have a fluctuation that is 1.5 times. So if market goes up 10%, you will expect the security to go up 15%. If market comes down 10%, you will expect the security to come down 15%. It's more volatile. If market has a risk of 1, this security has a risk of 1.5 times. So this is equation. You will see this at least 4 or 5 areas in your curriculum. And this equation is called as your CAPM, capital asset pricing model. We will derive this quantitatively in your portfolio management. We will conceptually derive this even in one of the prior topics in equity and in your corporate issuers. So many areas you will have the same equation that talked about here. Now, later on, we will use a discount rate for free cash flow to firm For that, the discount rate, can I use the equation above? Can I use the CAPM equation? No. Why? Because the free cash flow to firm, we said, is cash flow available to both equity and debt. This one is talking about the cost of equity. Okay. So we need to use a slightly modified discount rate, which is adjusted for the weight of the capital structure, weight of debt. So we are going to use WACC for it, weighted average cost of capital, as the discount rate. So in the exam, they might give you the WACC, they might give you the cost of equity. And if they're asking you to do DDM, you will choose cost of equity. Right? If they give you FCFF and they give you cost of equity and WACC, you will choose WACC, right? Because WACC is a weighted cost of capital, both adjusting for the debt and the equity's cost of capital. So it's just a weighted average. So if I tell you that RE is my cost of equity and RD is my cost of debt, and the amount of, or the weight in equity is WE, and W subscript D is the weight in debt. So this is on my equity side and this is on my debt side. My WACC is just the weight multiplied by the cost of equity plus weight multiplied by the cost of debt into the cost of debt. So this cost of debt is basically your interest rate adjusted for tax. So your interest rate multiplied by 1 minus tax rate is your cost of debt. If your interest rate is 10%, your tax rate is 30%, your cost of debt is 7%. Why? Because I don't pay taxes on my interest, right? So my cost of debt is going to be lower by the tax rate. So debt has that benefit. It gives you this tax shield. So we will subtract that, the reduction in tax, we will subtract that from the interest rate to calculate the cost of debt. If you are asked to do a valuation, you are probably going to be given the cost of equity and WACC. You will not be asked to calculate. But you need to know which one to use for which valuation. So if I told you that the market return is 14%, risk-free rate is 5%. If beta of BNP is 1.1, compute the cost of equity. How do you calculate beta? What's the formula? So new students, don't worry about it. Like, that's good. I just wanted to kind of connect with some of the other topics. So you can calculate it in two ways. Like, one is what Yuvan said, is to look at the correlation between the individual security and the market, right? Correlation is rho I comma m multiplied by standard deviation of the security divided by standard deviation of the market. The simpler equation is to just use covariance. Yeah, divided by the variance of the market, right? So these two ways you can calculate the beta. That's how, if you go to money control or they give you the beta, they do it this way. They look at the covariance between the market and the security divided by the variance of the security. You don't have to know it at this point. We'll see this in your quant, with portfolio management, many areas, how to calculate beta. But in your equity valuation, we are going to give you the beta. Don't worry about the computation. So this is your risk-free rate, 5%. So generally, I like to convert into decimal, but it's a linear equation. So you can directly use percentages. 5% plus beta is 1.1 multiplied by RM minus RF, which is 9%. So 5% plus 9.9, which is 14.9. All right. So the other thing that I have given you so far is the growth rate. How can we calculate? If I asked you to calculate the growth rate, what are the ways in which you can calculate the growth rate? I give you a company and I ask you, what is the growth rate assumption to use? How would you go about it? You have access to all the data. Okay, let's say you have access to all the data. How would you calculate the future growth rate? No, the growth rate of the future dividend. So right now the dividend is something. Say you're getting 50 rupees. How much will it be next year, the year after? You need to have a growth rate assumption, right? What is the assumption? How will you calculate that growth rate? If nothing, you don't know anything else, you can do what? Historical trend, right? What is the historical growth rate? How is the dividend growing in the past, right? So you just look at last 10 years or 20 years, how much is the growth rate of the dividends, right? Historical growth rate. See, if you're a quant, that's the first one you will do, right? Go look at the growth rate, dividend growth rate in the past, historical growth rate. Now, you can also look at industry rates, industry comparables growth rate, like what is the dividend growth rate in that industry? Because this might be a new company and you don't have history, but you might look at the peers, the comparable peers, right? Industry comparables. But we are now doing equity valuation and we like to go with a fundamental approach, okay? And we are going to use what is called as sustainable growth rate. So this is a formula that we need to know. I'll just give you one more formula, sustainable growth rate formula. Very simple. It is your retention ratio multiplied by return on earnings. B into ROE. Obviously, you can write B as 1 minus P multiplied by ROE. Both equations are valid. Retention ratio multiplied by return on equity. That's your formula for your growth rate. You know retention ratio. What's the formula? We just saw that's the first one of the first equations we wrote. This is your RE by net income, or 1 minus your payout ratio, or net income minus dividend divided by net income. Return on equity, we didn't explicitly talk about it today, but this is this return on equity itself is the formula, right? It already tells you what it is. Return on equity, super descriptive. Return on equity. What's your numerator? What is the return that you're going to use? Is your net income divided by equity. And usually we use average equity, not the current year ending equity, but the last year plus this year equity. Take an average, because the net income is driven by the equity, the beginning and the ending equity. Again, an important formula, I would say. We use this in many other areas as well. So now with this knowledge, I'm not going to give you the cost of equity. I'm not going to give you the growth rate. I'm going to ask you to calculate that and substitute and calculate the share price. Okay. So those two things you can now calculate it, right? And then you can then substitute and calculate the share price. Net income is 500 million. Retention ratio is 0.6. Number of shares, 100 million. Expected short-term growth rate. Expected short-term growth rate is 12%. And long-term growth rate is 6%. Short-term growth rate, we'll keep it 2 years. Otherwise, it becomes very difficult. Compute share price. So I will talk about the steps. The first step, obviously, is to calculate your cost of equity, right? So what is your cost of equity? The second step is to calculate the growth rate using your sustainable growth rate formula. And for that, you need to know the equity value. So I'm going to say the net income is 500 million on, so our asset is 10 billion and liability of 8 billion. Compute the cost of equity growth rate. Then once you have that, calculate the dividends D1, D2, D3. Use your D3 to calculate the share price at second year. Then add these two, dividend at second year plus value at second year, discount it. And you discount this one. And then we will combine this and discount it and sum this up. So this is going to be 13.6. This is your CAPM. 12% is your market rate. 4% is your risk-free rate. Now your growth rate is B into ROE. Your retention ratio is given directly, 0.6. What is your return on equity? 25%. Very good. How did we get this 25%? Net income is 500. Your equity is 2 billion. 10 minus 8. That is your equity side on your balance sheet. That is 2 billion. So your growth rate is 6.6 into 0.25. That comes to 0.15. That's like an ending or average. I didn't give you a prior year. So you just, if they don't give you that, just use the equity. What's your D1? So your D0 is $2, right? Your D0 is How did you get the D0 value? So 500 is my net income. So we said 60% goes to retention, which means 40% will come to dividend. 40% of 500 is 200. And this is 0.6. And this is 300. So this is being retained earnings. And this is my dividend. Number of shares is 100 million. So dividend per share would be dividend divided by outstanding shares. This is my D0. My D1 is going to be $2 multiplied by the growth rate in the short term, which we said is 12%. Store it in one memory slot. This is my D1 multiplied by 1.12. This is my D2. Store it in another memory slot. And my D3, you have to use the long-term growth rate. Okay, actually, I gave you the long-term growth rate as 6%, but we also calculated the sustainable growth rate as 15%. Okay, see, when you have a growth rate like 15%, okay, the problem is the Gordon growth model will not work if your growth rate is higher than your cost of equity. If you go back to your equation for GGM, VT is equal to dt plus 1 divided by R minus long-term growth rate. We want the value in second year. So I want to use D3 divided by R minus G. Okay. Now my R, we calculated as 13.6%. So the denominator is 0.136 minus the sustainable growth rate came at 15%. Okay. This is your sustainable growth rate. Whenever your long-term growth rate is greater than your RE, GGM cannot be used. This is one of the limitations of Gordon growth model. So the sustainable growth rate 15% can't be used. So you can use the long-term growth rate, which is like the industry average, which is the second method we said. So you're going to switch to, we calculated this, but we can't use this. We are going to switch to 6%. Okay. And why we can't use this? Because this number will become negative. The valuation will become negative. It doesn't make sense. Even if your growth rate is equal to R, then also the valuation will become, you divide it by 0, it becomes infinity. So you can't really use that. And in reality, if your growth rate is very close to cost of equity, also you can't use it because the valuation will be very high. Let's say this is 0.135. Your valuation is going to be extremely high. It's very sensitive, right? So the denominator, you have to be careful. So in those scenarios, you're going to adjust the growth rate based on the peers or comparables. And so I'm going to change this to the comparable long-term growth rate of 0.06. Okay. So now D2 is 2.506508 multiplied by 1.06. Store it in one more memory slot. Okay. So now this divided by R minus G, and that will give you the second year share price. And that comes to $35 roughly. I'll let you calculate the final steps. So discount it to today's value, your D1, you discounted PV of D1 plus your D2 plus your V2, discount that as well. PV of D1 plus PV of V2. So you add these three. So that is the value today, V0. Calculate the price today. Use your store recall in your calculator. It will be accurate instead of writing it down. So this was the share price. So we'll store this. Okay, my recall, this is my D1, 2.24. So this is going to be my FV. N is 1. Cost of capital is 13.6. Compute my PV. Store this in one memory slot. The next one is to use the share price we got plus the dividend in the second year, which is 2.508. So that becomes your FV in the second year. Then change your N to 2, compute PV, store this in one more memory slot, recall 1 plus recall 2, your share price is 31.03, right? So if you have done that, you will get the answer as $31.03. So your dividend, the the first value, the PV of the dividend should be 1.971, and the PV of the share price plus the second dividend, I got that as 29.05. If you add those two, you get this as 31.03. So we got this valuation, right? And how confident are we about this valuation? Are we good with this valuation? So let's say my share price in the market is right now $25. My CMP is $25. And the fair valuation we got is 25, right? Sorry, 31. This is my fair value. So are we confident if this was instead of 25, the market price is 20, will we be more confident or less confident with our recommendation? Our recommendation right now will be a buy because our market value is lower than my fair value, which means it is undervalued, and we will recommend a buy. The question I'm asking is, how confident are you with the recommendation? Just listen to this. This is important. There are some conceptual questions associated with this. How confident are we with our recommendation? So you are an equity research analyst. You're giving a buy, sell, hold recommendation, right? So how confident are you with that? Let me ask you this in another way. If the difference between the intrinsic value, the fair value that you calculated, minus the market value, which is your share price in the market, if this is higher, that difference, if this is higher, are you confident? Or if this difference is lower, are you confident? The triangle is the delta, the change, the difference between your intrinsic value and market value. Will you want the difference to be higher or lower? Higher. The more the difference, then the more chances you are right. Okay, if it is very close, the market price is 30 and you got 31, $1, like you could have made some mistake, the assumptions could be wrong. But if the difference is bigger, then the room for error is more, right? You have a better confidence interval, right? So the higher the difference, the more confident we are. Okay? Also, let's say after you give this recommendation, the stock moves in your directions from 25, it starts to go up, okay, to 27, like that. So you will be more confident if it moves in your direction of the recommendation. So this is obvious, but we just is given in the book. So the market moves in your direction. The third one is confidence on the assumptions themselves. So we talked about growth rate and all of that. Now, if that is built on a solid foundation, right? You forecasted it, you talked to the management, you forecasted the future cash flows, growth rate, the short-term growth rate, next 5 years or 6 years, you're projecting, those assumptions are good, then you're going to be more confident on your recommendation. Confidence on the assumption, if it is high, then we are going to be more confident on the recommendation. The fourth one they are saying is the valuation methodology. If you have used multiple valuation methodologies, you have used just one. Instead of that, if you have used 3, 4, 5 methodologies, and you have come to the similar conclusion in all those, or very similar. So you have used maybe DDM, FCF, FCFE, you have used residual income, all of those, and you come to a similar, more valuation methodologies, the better. And you will also try to compare with the implicit assumptions and see how that compares to your assumptions. If those are similar, implicit assumptions is closer to your assumptions, then you're feeling more confident. So right now you might not understand what is it. So what is the implicit growth rate? What is the implicit future ROE, return on equity? If those are similar to your numbers, then you're going to feel more confident.